I don't know. I mean, the CPI report, I guess it looked good. I mean, if you put it sort of against the backdrop of some of the other economic data that we've gotten, that's softening there and a lot of those price pressures. I guess the big question is that going to be enough to really alter the course and the expectations for where the economy ends up this year?
Well, if you think back to inflation, it peaked in June of 2022 at over 9% on the headline CPI, for example. Inflation cycles tend to be proportional. That had risen for about 13 months to its year-over-year peak, and it'll fall over about 13 months to October of 2023 to its year-to-year bottom. It could reaccelerate a little bit on full employment into the fourth quarter, and that would cause the Fed to retighten, but we'll deal with that in the second half. Right now, we've got lower inflation. Fed's going to pause in the second quarter. There's no official National Bureau of Economic Research recession in the first half. Lower real yields, higher price-earnings ratios, and all this argues for the technology stocks. They would work as a PE expansion play for a nice rally to, we say, 4,300. It could go a little above that.
And Barry, I do want to focus a little bit more on the intraday action. I know it's hard to make too much out of a single day, but the fact that we are only up about 0.3% on the S&P 500 after, again, we got what looks to be confirmation that the worst is over, at least when it comes to the inflationary pressures. Are you surprised that we're not necessarily seeing a bigger rally?
No, I think we need to see a more sustained decrease in inflation at the core level, and certainly in a number of categories. We also need to have some clarity on when the Fed's going to finish and where they're going to finish, but particularly when. But once we get that, I think you'll have a clearer picture that would cause a rally, as I said, in the first half, probably through April, May, June, and that would be a good rally for growth.